High conviction investing is an approach where returns are generated from a portfolio consisting of a concentrated number of stocks. With me today, I have Hamish Tadgell from SG Hiscock to discuss this investment philosophy. Welcome, Hamish.
Thank you, Darren. Thank you for having me.
Look, we might start the discussion just by going through what the merits of high conviction investing are.
Sure. Look, to quote Sir John Templeton, who always said that to deliver performance different from the crowd, you need to do something different. I think high conviction investing is about taking a different approach, or an active approach. Mm-hmm. I think SG20 and the SG Hiscock funds have shown that if you can do that in a disciplined way over a long period of time, you can generate outperformance relative to the market. I think the other thing, or the key behind high conviction investing, is that we're taking a different view from the market. So we're not necessarily owning just the index. We're actually actively screening stocks out on the basis that we think they're weaker investments. Yep. And we're trying to pick stocks that we think are got more positive attributes and going to be good investments. So it's an active approach, and as I say, when done in a disciplined way, we think can generate superior returns over the longer term.
Okay. More specifically, you look after the SGH20 fund. Yeah. Can you tell us a little bit about what the philosophy behind the investment in that fund is and what the key attributes of that fund are?
So the SGH20 fund is a high conviction, actively managed fund. We invest in 15 to 25 stocks. It's a long only fund, invested only in Australian listed equities. And we do that through a rigorous and disciplined approach, taking a reasonably fundamental approach to the way that we invest. As I say, the fund's been going for about 14 years, and over that time has been able to generate about 4.3% alpha or outperformance versus the ASX 300.
When you select your stocks for the fund, are there any particular areas of the ASX you look at when you're making your equity selections?
So we look at the whole market, the ASX 300, but I guess one thing about active investing and concentrated investment is having a process to narrow the universe down. So we have a number of screens that we screen companies out, quantitative screens is an initial process. So we take the 300 and we get it down to what we call a research focus list of about 150 stocks. And that's where our analyst team spends most of the time. And we try to analyse those stocks and then bring that down to about 30 or 40 stocks, which we call our recommended list. And that is the stocks which we look to construct the portfolio from. If you like, think about it as the stocks we'd like to own at the right valuation. And that's from those stocks that we really then look to build our portfolio.
So are there any specific research techniques you mentioned after the initial screening process that you use that you can talk us through a little bit more?
Sure, yeah. One of the things when we look for companies to invest in is we like to invest with tailwinds. Mm-hmm. So we like to find companies that are well positioned in industries which we think are growing above GDP. Yep. One of the tools that we use is to develop a thematic framework, or map if you like, of themes that we think are attractive. And I guess there's 5 big themes that we think about at the moment. That is technology everywhere, as we call it, changing consumption, the ageing population, low carbon economy, and then urbanisation. And underneath those themes, there's a number of different investment thematics that hang off them. And we think that provides a good backdrop in identifying those end markets, if you like, that are growing above GDP growth. And then the challenge, if you like, is to identify stocks which are well positioned within some of those themes. Now, one of the challenges in the ASX is that a lot of those themes are difficult to play. They just aren't the listed opportunities. And sometimes we need to look for second derivatives. So if I can give an example, we think obesity is it's a terrible disease, but it's a growing epidemic. Insulin companies, if we could find a good insulin company to invest in Australia, we think that would be an attractive investment.
Yep.
There isn't, but a second derivative, if you like, of that, which we think is very powerful, is sleep apnea. And ResMed, which is a company which focuses in sleep apnea space, there's a very, very strong correlation between obesity and sleep apnea. And we think it's one of the key drivers of the top line growth for that business. Our process then is very much focused on fundamental research. So whilst we focus on thematics, the actual stock selection and how stocks get into the portfolio is very much bottom-up driven. And that's driven around looking at the earnings growth of companies, and which we model out, and try to identify companies which we think have good, strong earnings growth, that are well positioned, and which are led by engaged management teams, and then trying to buy them at an attractive margin of safety.
Yep. So ultimately then the end result, how's the portfolio actually constructed?
So there's really four, different buckets that we think about the portfolio. As you say, we're trying to pick individual stocks, but we're also trying to, manage for portfolio risk in that. And the way that we do it is through trying to get a blend of life cycle and sectors across the companies which we're looking to invest in. And the way that we think about it, as I said, is really along four buckets. So the first bucket we think about is structural compounders. These are companies that typically the market underestimates the earnings power of the business, and they typically grow into that. And sometimes you have to pay a higher multiple for that. The second is what we call mature growers, and there's really two aspects of that. There's what we call stalwarts, which are more mature companies which are really well positioned in their industries, but generally eking out returns slightly above their peers. The third is really quality cyclicals, which is really playing the cycle, but with an emphasis on the quality of the businesses. So we're not generally we won't invest in companies that are really, really volatile, or where we don't have any transparency as to the drivers of that cyclical earnings. And the third is what we call emerging companies, and these are really more innovative and disruptive companies. They're typically a smaller percentage of the portfolio, and they're typically a sort of what I would call option for growth in the portfolio. And there's a policy really around up or out. If the concept or the idea is not working, then we'll typically trade it out. At the end of the day, it's about trying to get some balance between those four different buckets, and building a portfolio that over a 3 or 5 year view will outperform.
Yep. So then how often do you refresh the portfolio, and how long, I suppose, do you tend to hold on to your equities?
We've got a prescribed holding period. We look to... One of the real philosophies behind the fund, I guess, is that we're looking to capitalise on market inefficiency. And we think the market's inefficient in the short term and largely efficient in the long term. We can't control how quickly the market's going to price something in. We take a fundamental view around valuations and around fundamentals of a particular business, which we think is mispriced. If the market chooses to value that within a month, then potentially look to sell that. If the market takes a number of years to value that, then we're patient and quite prepared to hold that until the philosophy or the view plays out. So if you look at the history of the fund, though, the average holding period is probably somewhere between sort of about 18 months. But as I say, it's dictated really around the process and the disciplines that we have for valuation.
Yep. And if investors are looking to invest, what sort of returns can they expect?
So, as I said before, the fund's been going 14 years. Over that period, it's generated 4% a bit over 4% outperformance versus the benchmark. And that's really pretty much in line with our long-term target. So I guess the point here is that high conviction investing does come with some higher risk around volatility of returns versus the market. But we believe, as I said, if executed in a disciplined way, and I think we've shown this, that you can outperform over the longer term. So you really need to think about an investment horizon of sort of 3 to 5 years, and we would expect to deliver outperformance over that period.
So does that mean investors should be looking to make an allocation to the SGH20 fund over a period of 3 to 5 years? They should look to hold it for that long.
Yeah, exactly right. Yep.
Okay, well, if you liked all of what we discussed then, SG Hiscock will be one of the managers on our Undiscovered Managers Showcase. That event is taking place in October. We are presenting in Melbourne on the 23rd of October and in Sydney on the 25th of October. If you would like more details and perhaps to register for the roadshow, please visit the address on screen now and you'll be able to find out more about it. Thank you very much for your time today, Hamish, and we look forward to seeing you on the roadshow.
I look forward to that too. Thanks, Darren.